Hi everyone, this is Team 2 for Finance 624 and we're doing the leverage buyout of cheap products. So an introduction to our case study. We're gonna be studying Cheek Products Inc., which originally sold snack foods like pretzels, chips, but later on became a conglomerate with several different divisions like snack food industry, home security system, cosmetics, plastic, etc. The company has been underperforming, and Meg Wallen, which is a financial analyst, believes that the company is a good candidate for a leverage buyout. So what is a leverage buyout? Just quickly, is an acquisition of a company by a small group of equity investors is financed primarily with debt. The new shareholders serve as the heavy interest and principal payments with cash from operations or asset sales. The shareholders hope to reverse the LBO within 3 to 7 years, either by going public again or selling the company to another firm. Um, it's only going to be successful if it's able to generate enough cash to service the debt, and or if the company is attractive enough for other buyers later on in the future. Meg has suggested this LBO to her partners Ben and Brenton, and the question that they proposed to us was, if Meg, Ben, and Brenton decide to undertake the LBO, what is the most they should offer per share? There are three main approaches to valuation for the levered firm. There's adjusted present value approach, APV. APV equals NPV plus NPVF. There's flow to equity approach, FTE, which we give the steps. Step 1, calculate the levered cash flows. Step 2, calculate RE. Step 3, value the levered cash flows at RE. And there's weighted average cost of capital, WACC, which we give the formula. But if you guys want to know more about it, you should read the chapter. And we're going to be using adjusted present value approach, APV, for our case study.
Megan, a financial analyst, has provided a 5-year projection of cash flow. The items included in these projections are as follows: sales, cost, depreciation, capital expenditures, change in net working capital, and asset sales from 2012 until 2016. These items are really useful in order to calculate or compute the unlevered cash flow. At the bottom of the table, we can see like the interest payments over the 5 years. That is like the interest payments on the debt if the leverage buyout of Czech products is undertaken.
These are some of the numbers that are given in the problem, and we're going to be using these numbers throughout our calculations of APV. So the steps that we're going to be using to calculate APV. The first one is we're going to calculate the present value of unlevered cash flows for 5 years. Then we're going to calculate the same thing, but for beyond the 5 years. We're going to calculate on third step the present value of interest tax shield for the first 5 years, and on fourth step the same thing, but we're going to calculate beyond those 5 years. And throughout the presentation we're going to give more details into each of those steps.
Thanks to the table provided by Meg in the previous slide, now we can compute the present value of unlevered cash flow for the first 5 years. Starting from the sales, cost, depreciation, and taxes, we can compute the net income. After have computed the net income, if we add the depreciation minus capital expenditures minus change in net working capital plus the asset sales, we can have as a result the unlevered cash flows during the 5 years analyzed. After have computed the unlevered cash flow in the previous slide, now we can work with the present value of unlevered cash flow. The sum of present values of unlevered cash flow is given by discounting The cash flow over the 5 years discounted with the company return on assets percentages, which is 14%.
Two, we are calculating the present value of the unlevered cash flows beyond the first 5 years. First, we're going to calculate the terminal value, which has the formula written in the slide. Then we're going to calculate the unlevered cash flow value in year 5. After that, for the PV of all unlevered cash flows, we're going to sum those two values from those two formulas, and then we're going to get 13,391.5. In this step, we're gonna calculate the present value of interest tax shield for the first 5 years. So first, if you look at the table, we have the interest paid from year 1 to year 5. This is given in the book, in the problem, these numbers. Then we're gonna apply the taxes of 40%, the corporate taxes, over the interest paid. And we're gonna get what we have to pay for corporate taxes. And in order to get the PV of interest tax shield for the first 5 years, we're gonna have to discount the tax rate over the 5 years, and we're gonna discount the debt yield to maturity, which is 12.5%. After we sum all of those values, the 5 values, we're gonna get the PV of interest tax shield for the first 5 years.
In the following slide, we can calculate the weighted average cost of capital, which is 12.88%, and the leverage equity return at 14.9% from the financial table seen below. The following slide is a summation of all the results that have been calculated. Some of the formulas used are as follows. Terminal value of levered company, which equals to 13,814.71. Interest tax shield beyond year 5 is 1,473.57. And lastly, value of terminal tax shield equaling at 817.73.
In this slide, we are going to compute the total value of the company, which is given by the present value of unlevered cash flow, which is equal to 13,391.5, and the value of all tax shield, which is equal to 4,029.62. The most the group should offer in the end per share is equal to the total value of the company divided by the outstanding shares, which equals to $40.99.
To conclude, if Meg, Ben, and Brandon should undertake the LBO, they should offer per share $46.92. And if Chick Products would actually undertake the LBO, some of the changes would be the change of CEO, adjustment on the pay of directors, and alteration in the structure of the board.